Hello people, hello traders, how are you? This is Shlomo Cooper and I'd like to start our weekly session of the Investors Club. So let's start by talking about Deutsche Bank, which was, the big elephant in the room in the past week. Winston Churchill once said, there is nothing more exhilarating than to be shot at with no result, and that is pretty much sums up Friday's action. So on Thursdays the market crattered because of worries that the Justice Department would wipe out Deutsche Bank with a huge fine. I say it was unlikely, given that it's not really in anyone's interest to have that happen. Still, we were bombarded by calls that said that this one's the next Lehman Brothers, which is, called for it's the end of the world as we know it. But pessimism hasn't been a very good trading approach in this market for quite a while, and here we have another good illustration of that fact on Friday. Is the worries about Deutsche Bank that we're building have suddenly been shunted aside. So on Friday, when we learned the world might not end and that the Justice Department might be on the verge of settling with Deutsche Bank for an amount that it had for an amount which is much less than everybody thought for the first place. In the first place, so the market had reversed and it just took off. And first of all, just want to show you in our first slide the connection, the relationship between the market action, the price action of the S&P 500 here on the blue line. This is the left axis, the S&P 500 on the left axis, and the green line, which represent Deutsche Bank price action on Friday, in the right axis. And you see that actually the direction Deutsche Bank went, this is exactly the direction the S&P 500, they were just hand in hand tied together. So there were on Friday actually there were various defenses from the Deutsche Bank CEO and others have had no impact on the stock previously, but Friday's morning there was talk that Deutsche Bank may be able to settle a lawsuit with the Department of Justice for only $5.4 billion rather than the $14 billion that was initially discussed. And when we learned once again the world might not end and that the Justice Department might be on the verge of settling with Deutsche Bank, everything just reversed. So that turned the market, and we had been trending upward on exceptionally strong bridge. Let's just take a 5 minutes chart here of the S&P 500 action on Friday. All right, so this would be right side of the very ugly big red bar at the end of the day, and maybe that is connected to the window dressing and the end of the quarter placements and adjustments of portfolios. That was just a gap and go since early in the trading, and this is Deutsche Bank took off at the start with a huge gap up, and that only got stronger and stronger till the end of the day. On the daily chart, this is the action of Deutsche Bank, and some sort of a W formation. This is absolutely a reversal pattern on the daily chart. Now that is how it always works. You get some event involving some big bank that is indeed sick, you fret, you worry it is Lehman Brothers, and then the authorities avoid Lehman, because as stupid as you think the authorities are, they don't want to be as stupid as the government was when Lehman went under. So that is what is happening right now. So the first question is, will there be a deal. So there better be, or we will reverse. And but it is logical that there be one. Okay, so if there is one, will those who talked about it as the end of the world be shamed into saying, well, I'm sorry, I was wrong? So absolutely not. Will they be chastened next time? No. Will they be stars? Yes, always, because that is just how it's been since the Great Recession and the dot-com blow-up and the crash of '87. The bad news bears always win in the press, but they often lose in reality. I think the latter matters to all but those who want to inflame. It's not right. It's just the way it is. This is reality. Now, given the nature of this market for the past 7 years, it shouldn't be too surprising that the Deutsche Bank crisis suddenly comes to an end and the market acts like nothing happened. There is a long line of similar events in the past, such as, and we can count a couple of them, the debt ceiling, a Greece crisis, the Brexit we've just had back in late June, and you see the reversal here. The market just plunged for 2 days and then reversed it all, going into a new all-time highs. The news is also made it easier for window dressers, to march a number of stocks back up so they can post better numbers for the third quarter. Thinner, small caps in particular are benefiting from this action. Biotechnology, semiconductors, and oil-related names were leading to the upside on Friday. Part of the names that I'm looking after are, first of all, FMSA, right, which is going into the all-time highs set back in July around $8.83. This is a small oil-related name, but I'm looking for an entry and looks great before breakout. Another, a stellar name is from the oil. It's REN, and this is just amazing. One of the most amazing charts I encountered recently. From July, the stock was traded below $5 a share, and right now it's above $25. That is 500% times 5 on your money in the last 2 months or so. And I'm just look when it made the last pullback back to the rising 20 days moving average. This is a great reversal to take action and to load some shares in your portfolios. And right now it went to a new all-time highs, and I'm not going to chase this name. I'm just going to trade around it, and if it can come back in the next week again to the area of the rising 20 days moving average, and even best to go into some deeper pullback back to the recent support it's set in late August around $15.75. This is coincide with the rising 50 days moving average around 1770. This is going even to offer us a better entry. So this is a REN, which is part of a couple of oils that are doing really well recently. On the biotech screen, first of all, SRPT, which I discussed last week, and I'm holding a position there. Another stock that I'm holding a position in is PETX, which we really went into depth, and I showed you how to trade PETX and the SRPT. SRPT, we called it the chase trade, and the PETX is to start a position before a breakout. And two other names that I'm following right now, and they are on my screen. TRIL from the biotech, TRIL, a very nice uptrend that is developing right now, and around the 20 days moving average, another entry it may offer us. And ARRI, which is just on Friday, it seems it started to continue the surge we saw early in the week when it more than doubled its value. Now, one of my favorite biotech names for a while has been Global Blood Therapeutics, GBT. And the stock and I talked about GBT a couple of times recently, and the stock received initial coverage on Friday from Wells Fargo and was given a whopping target of $75 to $81. So this is, huge upside for the stock because of the potential for treatment of sickle cell disease. The stock was up on Friday nicely, and I'm looking for additional entries on this name. By the way, it's still, you can see here the declining 200 moving average on my screen in the orange line, and let's see if it can go over this line. Of course, if we are going to see it anywhere around the target of the target that was set by Wells Fargo, a very respected investment bank, then of course it should leap about it cross this line. Now, this market has been, very good at making fool those folks feel foolish if they play defense at the first sign of trouble. It made sense on Thursday, with the Deutsche Bank and everything around it, that it felt quite smart, to play a little bit of defense. But on Friday, it is as if nothing had happened. The indices have dodged another bullet and are firmly back within a trading range. There is a chance that the Deutsche Bank drama isn't over yet, but the bulls seem to be wearing Teflon armor. The birthday will eventually come one of these days. There is going to be a major event that will have some teeth and will badly burn the very confident bulls, but we just have to wait for the price action to tell us when the time is right. It's not there yet. For the meantime, it has been delayed again. There are plenty, of bearish big picture arguments that can be made, a long list of them, but once again, the price action is the key, and it looked quite good right now as we are heading into October and the fourth quarter of the year of 2016. And this is a great time, to talk a little bit about Q4 statistics. So as September comes to an end, if we look on investor mood, it has turned somewhat dour. The market has been confronted by banking troubles. It's not just Deutsche Bank, it's also Wells Fargo. There is also uncertainty over the outcome of the presidential election and the continuing question of when the Federal Reserve will raise interest rates. The next two Fed announcements, by the way, are scheduled for 2nd of November, and then after the 14th of December. December holds the most probabilities, as Janet Yellen is expected to hold a press conference after that, and the November meeting does not have any press conference after that. Now, on the bright side, despite these concerns, if we just take a look on the VIX, and I'll share my screen once again, a VIX dollar sign. Okay, so the VIX on Friday went back to the 13 points level once again. So right now it's hardly an elevated reading right now, and the S&P since the start of the year to date is nearly 7% up. So that is quite good. We are also entering the seasonality bullish fourth quarter, and since 2000 and this is the summary statistics of the SPY during the fourth quarter since then. So stocks tend to rally into year end with an average gain of 4.5%. Then I split the sample according to whether S&P SPY was positive or negative year to date. So as you can see, when SPY is positive going into the fourth quarter, it has rallied 6.6% on average into year end, while being up in 8 of the last 10 occasions. The other notable characteristic is how low the variation around these returns has been, with a standard deviation of only 6.8% versus 16.5% for fourth quarters that began in negative territory. In other words, despite all the reasons to worry, the historical evidence based on seasonality suggests the trend of low volatility rise will continue. Okay, so with that in mind, let's go into the last quarter of 2016, and I want just to point out 5 stocks. I believe these are 5 of the best stocks to behave in the last stretch of 2016. Now, it's a little bit tough to be bullish on any stock right now, because it seems that the market is stuck once again in the very long, tight trading range, and the market simply hasn't followed through on any bullish efforts of late. This is, by the way, the same case for the bearish side, and this is exactly why we are just stuck in the mud. But possibly part of the reasons are because it's well overvalued and earnings growth is anemic, and we are going to start in 2 weeks time. We are going to start to hear the numbers, the earnings numbers, the earnings figures from the American companies. Now, of course, it's not clear how either presidential candidate will impact the economy, so there are some clouds of uncertainty. But if the market does its usual fourth quarter thing, the coming 3 months should be good ones for stocks. And as I showed you right now, the average fourth quarter performance for the S&P 500 is a solid 4.5%, and this is a positive year till now, so it even goes higher. So that makes it the best 3-month stretch all year long, and still, as is always the case, you know, some stocks are going just to perform better than others. So let's just take a closer look at the top 5 best stocks for me to buy to finish 2016 on a strong feet. I want to start with WY, and right now we are going to see all of the stocks that I'm going to present you on a weekly chart, which means each bar represents 1 week of price action, and usually we are going to take a look on the last 2 years at side. So, you know, so for WY, as you can see right now, it's not very often that a paper or a timber real estate investment trust shows up on a list of the best stocks to buy, but WY has earned the accolade. Goldman Sachs agrees, and WY is a REIT, meaning it's built from the ground up to pay dividends from its paper and timber businesses. It's done so reliably too, and currently yields a healthy 3.8%. So investors like it, love it. While the wood business can ebb and flow, of course, prices are relatively firm now, but no dangerously overextended and ripe for a pullback. And Goldman Sachs put WY into their conviction list earlier last week, so WY is the first on our list. Let's move to Amazon, and what a nice 2 years of Amazon. Amazon started 2015 around $300. Right now, it's about to reach $900 per share very very soon. Given the company's sheer star power, there is never, necessarily a bad time to buy Amazon. But at year end, with the holiday season driving frenzied spending and online spending now exceeding, brick and mortar shopping during this busy time of year, Amazon stock is another one of the best stocks to buy for a shot at finishing 2016 on a bullish foot. Is the trailing price earnings ratio of 200 is simply too rich? Maybe so, although an excessive valuation has rarely held Amazon shares back in the past. Indeed, the Mitsu Investing House recently upped its price target on Amazon from $855 per share to $950 per share. This is 18% higher than the stock's last price, so it has much more room to rise, according to Mitsu at least. We are going forward to Textron, TXT. This is the third on our list, and Textron isn't exactly a household name, but that doesn't mean it wouldn't be a solid play for the last quarter of the year. Textron is a defensive contractor. It doesn't make anything that is overly high profile, like the F-35 fighter jet from Lockheed Martin, though it's the parent company of familiar name Bell Aircraft, and it makes a few types of armored vehicles. Those who know the Textron story well will know TXT stock hasn't been a great performer of late, and you can get a good sense of it just taking a look at the chart. And even with a 28% rally since February's low, the stock is still 15% below its mid-2015 peak. In that, both presidential candidates Trump and Clinton have vowed to keep spending on defense if elected, so investors may find Textron finds a tailwind few were expecting it to see as the year comes to a close. So TXT is the third on my list. Fourth one is Western Digital, WDC, and this is a name I've been trading for the last couple of years, day trading, but I'm looking to buy it into the last fourth quarter, as a long-term investment or core investment. Last year was nothing less than a miserable year for Western Digital, at least for Western Digital shareholders, and you can just take a look on the bloodbath it went into it, actually plunging from $110 per share into around $55 per share, actually cutting by half. But right now, after building here a bottoming base, it's starting to move its head up, going into the high of the year of 2016. After peaking near $113 in January 2015, so WDC stock spent the next 17 months actually losing 69% of its value before right now reaching around $35 per share. Okay, but Western Digital, worth the risk, and it's still, having a trailing PE of 57, and the technology outlook is loaded with uncertainty. But there is an element of risk, to be sure. But now that the dust is settling after the merger with SanDisk, analysts see something compelling here. And Longbow research firm recently added WDC to its list of best stocks to buy here, pointing to an unexpected uptick in demand and the benefit of its deal with SanDisk. Longbow thinks the stock's worth $70 per share, which is, about right now it's trading for about $60. So there is, at least an upside of $10 or more per share, about 15%. That is good. That is quite positive. Okay, the last one on our screen is going to be Bank of America, and while none of the major banks have been stellar performer of late, especially talking about Deutsche Bank and Wells Fargo, Bank of America has been particularly troubled since early 2014. In early 2015, though, it was one of the few banks that failed the Fed's so-called stress test, and though it passed the test in the most recent round of scrutiny, the stigma has somewhat just got into the stock. Now, Bank of America kept chugging along, though, cutting expenses to the bone without crimping its capacity to do business. Now the bank has emerged from tough times fit and trim, and with interest rates poised to rise sooner than later, and probably this December, margins could widen faster than anyone anticipates. As Goldman Sachs analyst Richard Ramsden said, we believe, and I quote, we believe that Bank of America is on the cusp of an inflection in operating leverage as revenue growth and cost reductions appear set to occur concurrently. So Bank of America is just packaging the list of the 5 stocks to buy for the last stretch of 2016. Before finishing today's presentation, let's just take a look on, first of all, our 2 stock picks for the past week. We will see what they did, and let's also go into the 2 stock picks for the coming week. So first of all, TPIC and WOOF. We had TPIC, a recent IPO for a long above 2180. Let's take a look on the chart. TPIC. So actually, TPIC got into play on Wednesday last week, just breaching the level of 280, went up almost $1, enough to put money in the pocket, and once it just come back, this is the time to get out of the stock. So this is for TPIC. The second one was WOOF below 67.36. There was just a great support level. It was about to break. Let's see what happened to WOOF, WOOF. So actually, WOOF actually penetrated the support line, going down on Monday, and actually got me into the trade, but it didn't have any more firepower for the bearish side and just went upwards. So this is of course a failure. For the next week, we are holding here 2 stock picks, one up, one down. The long side is for NTAP. Just look how it has here. It's holding here a very nice gap up since mid-August, and right now just going sideways. And just think of all the energy that NTAP is right now try to gather before a breakout. So I just want to get on the stock on the breakout if it can go above 36.1. The second one is Tractor Supply, TSCO, that is suffering a very long downtrend and then just tumbled early in September, and right now building a bearish inverted cap, and we just want to see if it can break below the previous low of 66.77, which should send the stock much deeper. Thank you very much for being here with me for this for this homework and preparation for this week, the first week of Q4. Hope this is useful information, and as always, we are going to be here with you next week. So thanks all, and have a great week, all of you. Bye bye.